Let's have a look at task 2 from the first sample assessment for business tax. Task 2 is about capital allowances. You can see it's for 12 marks, which is a good chunk of the marks for your exam. And with lots of practice, you should be quite competent at this. So let's have a look at the information. We've got quite a lot of text given to us and some tables. So let's just skip that for now and have a look at the requirements so that we can look at that information with purpose. So part A asks us to complete the capital allowance computation for the period ended 30th of June 2024. The brought forward figures have already been entered. You should ensure that any additions qualifying for AIA and FYA are included in the appropriate column. All allowances are included in the total allowances column. The total allowances for the period are clearly shown and the carried forward balances are clearly shown. So there's quite a lot for us to do here. We need to make sure that we do all of these. Any columns that are not required should be left blank. So there's 9 marks here. And you can see that in the answer they've given us a free form table. The headings have been provided for us already and the brought forward balances have been included. So this is a human marked answer. So you need to make sure that when you're completing the table, you've got enough information here for the marker to understand what you're doing. So we need some sort of text in the first column to help explain what's happening. Just a series of numbers just spread around the table will be difficult for any marker to be able to follow. So let's have a look at the information they've given us, and the approach we'd recommend is that you go through the question logically from the top through to the bottom so that you don't miss out any of the data that they've given you. So we're told that Robert is a sole trader and has always used the accruals basis of accounting. And that's relevant because we wouldn't bother with capital allowances if we're using the cash basis. So on the 1st of July 23, he had the following brought forward tax written down values for capital allowances. So we've got the general pool and Robert's car, and those 2 numbers have already been included in the table. So there's no mark available for putting those numbers in again. We're told that Robert's car had carbon dioxide emissions of 170 grams per kilometre and had 45% personal use. So we don't need that information quite yet, but we'll come back to that a little bit later. So because we've not used it yet in our answer, we can highlight it to remind ourselves that we need to come back to it. And during the year ended 30th of June 2024, the following transactions took place. So first of all then, on the 1st of January 24, they bought an electric car and 45% of it was used by Robert. And there's the value of the car of the 32,800. So we can enter that into our answer. So we have our electric car, which we bought on the 1st of January 24. And it had a value of 32,800. So that's the figure that we would put into our columns. But remember that 45% of the time, the owner is using it for private use. So that means we can only include 55% in our capital allowance calculation. But what we need to decide then is which column are we going to put it into. So let's remind ourselves what these different columns are all about. The first column, AIA, relates to the annual investment allowance. And this is a type of capital allowance which offers tax relief at 100% on qualifying expenditure in the year of purchase. There is a cap of £1 million per year. So we might want to use other columns where there is no cap. So we want to make sure that because there's a limited qualifying use for this allowance, we want to put as much as we can in here up to the cap. So it can be used against qualifying expenditure, which includes plant and machinery, integral features of those, long life assets and private use assets, but not cars or structures or buildings. So we have an electric car here, which means that it may not be used in the first column. So what about FYA? So this relates to first year allowance. So again, this is a type of capital allowance which offers tax relief at 100% on qualifying expenditure in the year of purchase. But in this case, there is no limit on the qualifying amount, but the qualifying assets are very restricted. So what is allowable in here? So qualifying research and development capital expenditure could be included in here. New and unused low emission cars, but not second hand. So to qualify as a low emission car, it must emit 0 grams per kilometre of carbon dioxide, or it must be electrically propelled. So this would be relevant in this case. Similarly, new and unused, but not second-hand, zero-emission goods vehicles. So your vans or lorries, again, which are zero emission. Also, electric charge point expenditure can be included in here. Plant and machinery can be included if it's purchased in a designated assisted area within an enterprise zone. So in this case, it would make sense that we put our electric car expenditure in the first year allowance column because it meets the conditions being a new electric car. And by putting it into this column, it means we're not using any of the 1 million cap for the first column. And because we get 100% capital allowances for first year allowance, this is going to be preferable than putting it into any of the other pools. So let's go and have a look at the next purchase. So on the 14th of March, we purchased some plant for 112,000. So where should we put that? So it's the 14th of March 24. We have some plant. So the plant does not qualify for first year allowances because there's no information about it being in an enterprise zone. It could go into the general pool, but then we'd only get limited written down allowances. So it makes sense then that we put all of this into the first column so that we can claim 100% allowances on this, and it's below the 1 million cap. And then on the 15th of June, we bought another car. It has carbon dioxide emissions of 82 grams per kilometre, but 65% is personal use by the production manager. So this is on the 15th of June, and we have the car. So here's the reference materials for business tax, and we're looking at section 5 on capital allowances. And there's a bit of information here about cars. So the amount of the writing down allowance depends on how many carbon dioxide emissions we have. So as we saw with our electric vehicle, we can claim first year allowance of 100%. So we did that already. And then if we have carbon dioxide emissions of up to 50 grams per kilometre, so we can put them in the general pool with 18%. But as we have over 50 grams in this case, then we're going to have the special rate pool of 6%. So we need to put this car in the special rate pool column, and we put the 18,900 here. Now notice the slight difference between the two cars that we've included. So the first car was being used by the owner, so we only included the business use in the capital allowances calculation. Whereas for this second car, we're putting the full value in the special rate pool because this car is being used by an employee. So HMRC will gather tax from the employee because this is their benefit in kind. So that means we're going to put the full value of the car in the capital allowances calculation. So we've also got some disposals. On the 31st of October, we disposed of some plant for 8,600. So we can include that in our answer as well. So the plant would be included in our general pool. So we can include the reduction, 8,600, in the general pool column. And then on the 19th of December, we disposed of Robert's car, and remember it told us earlier that this was a polluting car, 170 grams per kilometre with 45% personal use. So we disposed of that for 12,900. Now, as this was Robert's car, then we're going to use this in the private use asset column. So we've got the 12,900. But remember, we're taking this away. Yeah, these are the proceeds from the two disposals, and we're putting the proceeds into the relevant columns. So we've gone through all the additions and disposals. So that's all the information, all the numbers from the scenario into our table. So it's now time to start working out our capital allowances. So in the first column with our annual investment allowance, so we have a 100% allowance here, so we can take the full 112,000. So this is a capital allowance, so let's put that in the final column as well, because we'll want to work out what our total allowance for the year is. And then next we can do our first year allowance. So again, we get 100% allowance on that electric car. So we can put that in as well, and again add that to our final column so we can work out our total. Now, before we can work out our allowances on our general pool or any of the other pools, we need to work out a subtotal. So in the general pool, we have a subtotal of 78,142. In the special rate pool, we have a subtotal of 18,900. And in the private use pool, we have a subtotal of 11,482. So let's deal with that private use asset first, because remember there is a disposal here. So when we have a disposal, that means that this column should be 0. Yeah, we should have a carried forward balance of 0 here. So what we need to do is remove all of the 11,482 so that we have a 0 carried forward balance. Yeah, the asset doesn't exist anymore, so we shouldn't have any value here. But remember that this was a private use asset and Robert was using it 45% of the time. So for this balancing adjustment, we need to make an adjustment to this for the 45%. So in terms of the business use, yeah, we have a 55% adjustment. So we've got the 11,482 and we multiply by 55%, and that gives us 6,315. Now what we need to decide though, is that going to be a plus or minus? Is this a balancing charge or a balancing allowance? So remember, our opening balance, we have 24,000 as the written down value. We've sold the asset for 12,000, which means in our tax accounts, we have an asset worth 11,000, and we've not claimed all the capital allowances for this. So on disposal, any written down value that's still available can be claimed as a capital allowance. So we've got a balancing allowance of 6,315. So that's the 11,000 multiplied by the 55% business use. Now let's suppose that we sold this asset not for 12,000, but let's say 32,000. In that case, we'd be making a profit on disposal, and in that case, we'd have a balancing charge. So we'd have to pay a bit more tax then because we've got that profit on disposal. But in this case, we've not used all of the original cost in our capital allowances, so we get an additional allowance. Okay, what about the general pool and the special rate pool? So we can have our written down allowances. So first of all, at 18%, so that's going to be for the general pool. So 78,142 times by 18% gives us a writing down allowance of 14,066. and that allowance can be included in that final column. And then we also have our written down allowances at 6%. So this applies to our special rate pool, which was our high carbon dioxide emission car, so it's our polluting car. And because it's polluting, we can only claim a 6% allowance for that. So we take the 18,900, multiply by 6%, and that gives us a writing down allowance of 1,134. And we can include that in our final column. So there we are, there's our capital allowances, but what we need to do is just make sure we've done everything so we don't throw any marks. So we should ensure that any additions qualifying for the annual investment allowance or fresh allowance are included in the appropriate columns. So yes, we've done that. All allowances are included in the total allowances column. So yes, every allowance, the negative numbers that we've shown here, have all been shown in the final column as well, taking into account the private use for the car. So we've done that. The total allowances for the period are clearly shown. So we've not done that, have we? So we need to add up the total figure for the last column. So our total allowances amount to 151,555. So you've done that now. And we also need to show the carried forward balances, and we've not done that either, have we? So let's complete that. So we've got our carried forward balances. So in the first column, there is no balance because all of the additions has been fully written off. And then in the first year allowance column, again, we've got no carried forward balance there because all of the additions have been fully written off. And then in our general pool, so when we total up these figures, we have a carried forward balance of 64,076. And for the special rate pool, we have 17,766. For the private use asset that's been disposed of, and we have a 0 carried forward balance for that one. We now move on to part B of the question. So Darren is a sole trader. He had a tax written down value of 18,000 on his general pool at the 1st of July 24, and he ceased trading on the 30th of September 2024. On cessation, he sold his assets and received proceeds as follows. So he received £20,000 for the plant that he sold and £8,000 for an electric car on which a 100% first year allowance had been claimed. The car had no private use. So we need to explain the capital allowance implications of the cessation and disposal of Darren's assets in his business. So the first answer we can provide then to get our mark is that there is no written down allowance in the year of cessation. So how is it going to work? We sort of saw this a little bit in part A of the question where there was a disposal. So we're going to have some disposals here. But in this question, it's asking us to explain. So what we're going to do is show you the same sort of table, but we don't need to do the table for the answer, but I think it's going to help us to understand what's going on in this particular case. So here's our starting position. We've got a brought forward tax written down value of 0 for the first year allowance column. It's going to be 0 because every year that we've used it, we've had a 100% allowance, haven't we? And then for the general pool, we've got the brought forward balance of 18,000. So we have our cessation, and what we do, we sell our plant, and that plant, we're going to have proceeds of 20,000 for that. So we're going to reduce our pool by the 20,000. So we can see we're going to have a negative number here. So there's going to be a balancing charge. Because for tax purposes, we can show an expense of 18,000, but we have proceeds of 20,000. So we're making a profit on the sale, aren't we, for tax purposes? And if we have a profit on the sale, then we need to have a balancing charge so that we'll pay more tax. Now, what about the electric car? So for the electric car, that was previously included in the first year allowance column, but we've got 0 here, haven't we? So we've sold it for £8,000, we have our proceeds. So, what we might think logically, well, let's put the £8,000 here, but we can't really because we've got a zero opening balances. We can't really deduct 8,000 from the zero. So what we need to do then is deduct the proceeds from the sale of the car from the general pool. So once we've done that, it means that when we do our subtotal, we have a subtotal of negative 10,000, and we need to set it to zero. We need to make sure we finish the business with zero balance here. So that means we're going to have a balancing charge. So that 10,000 will be added to our trading profits, and we'll need to pay tax on that. It's to recognise that we've made a profit on the disposal of these assets for tax purposes. So in our text box, we can say that the proceeds from both disposals are deducted from the general pool, and there will be a balancing charge of £10,000, which will be added to our taxable profits. Yeah, and then finally, a company is building a new factory. Construction will commence on the 1st of October 2024. And we need to identify whether the statement is true or false. So the construction costs incurred will qualify for full expensing. So what do we mean by full expensing? So for expenditure on main pool plant and machinery from the 1st of April 2023, companies are entitled to claim full expensing. So they can have a 100% first year allowance. Now this allowance is not capped, unlike the investment allowance, but can only apply where the expenditure meets the following criteria. So it must be new, in other words, not second-hand. It must be acquired from a third party. It cannot be used for leasing and does not include cars. So in this case, we're looking at the construction cost to build a new factory, but that's not plant and machinery, is it? So therefore, it does not qualify for full expensing, and this answer is false.